It's June 12, 2026, and the noise across social groups is a heavy blanket of retail fatigue. Influencers and standard chart analysts are obsessing over Bitcoin grinding below the $63,000 mark, warning of a potential drop to a $48,000 max pain scenario, and tracking persistent spot ETF outflows. The casual retail crowd is convinced the cycle has ground to a complete halt, but the signal today is an absolute lightning strike. While retail traders are waiting for a standard directional pump, the structural connection between Wall Street and public blockchain networks didn't just expand. It fundamentally consolidated. The SEC just proposed to scrap key national market system, NMS rules. Analysts are rapidly realizing this is a historic systemic unlock for tokenized U.S. equities. Within hours of that regulatory shift, Exodus and Ondo Finance launched a live tokenized marketplace, deploying over 200 public stocks and ETFs natively on Solana. To seal the institutional takeover, BlackRock just filed an 8A for a brand new yield-bearing Bitcoin ETF, with an anticipated launch next week. The legacy system isn't replacing public crypto networks, they are turning them into their primary backend settlement layers. Today, we dive into the details of the SEC's rule changes, unpack the tokenized stock wars on Solana, and break down why BlackRock's shift to yield-bearing vehicles changes everything. My name is Noel. Welcome back to the Signal and Noise podcast. Let's dive in. Let's break down the most technical and heavily searched policy topic dominating the algorithmic feeds today: the SEC's sudden proposal to scrap key national market system, or NMS, rules. To most retail traders, NMS sounds like boring legacy bureaucratic alphabet soup. In reality, it is the ancient, highly rigid framework that dictates how U.S. stocks must be routed, cleared, and executed across legacy public exchanges. Under strict NMS guidelines, stock trading required highly centralized clearinghouses and strict market maker reporting parameters, and fractional settlement windows that essentially barred real-time peer-to-peer asset transfers. By proposing to dismantle these restrictive rules, the SEC is essentially conceding that modern cryptographic rails can clear and settle financial instruments with vastly superior efficiency. Quantitative policy analysts are already declaring this a major structural unlock for tokenized equities. This single regulatory shift removes the legal friction that prevented Wall Street firms from taking traditional equity shares and wrapping them natively as on-chain tokens. It transitions tokenization from a boutique experiment into a compliant, mainstream financial standard. The market is no longer wondering if stocks will live on public ledgers. The regulatory infrastructure is actively clearing the runway to make it a mandatory structural reality. This brings us directly to the massive product launch causing an absolute firestorm on crypto Twitter today: the joint deployment by Exodus and Ondo Finance. Literally hours after the SEC's policy direction became clear, these two entities launched a tokenized market delivering over 200 blue-chip public stocks and exchange-traded funds directly onto the Solana blockchain. This means an investor anywhere in the world holding basic stablecoins can instantly swap into a fraction of a tokenized US tech stock or an index fund at 3 a.m. on a Sunday. The rigid 9 to 4 closing bell of Wall Street has been functionally bypassed. At the exact same time, Ethena Labs announced it is allocating a massive $250 million of its backing assets into Securitize's tokenized AAACLO fund, deploying those funds directly onto Solana rails. This fundamentally validates the network as an elite institutional-grade execution layer. We are watching public permissionless layer 1s actively absorb the liquidity of the traditional stock market. The speculative asset layer of the past cycle is being aggressively replaced by high-fidelity, real-world asset pipelines. Now let's look at the absolute titan of the asset management world, BlackRock. While retail investors were complaining about Bitcoin's short-term price drawdowns, BlackRock quietly filed its Form 8A for a brand new, yield-bearing Bitcoin ETF. The first generation of spot Bitcoin ETFs simply tracked the raw spot price. They were passive holding vehicles. But BlackRock's new filing signals the next logical evolution: programmable yield. Analysts anticipate the launch as early as next week. BlackRock is transforming Bitcoin from a sterile store of value into an active, dividend-producing, institutional financial instrument. Think about a massive pension fund or a sovereign wealth entity. A regulated yield-bearing Bitcoin ETF backed by BlackRock completely aligns with their traditional mandates. This ensures a structural, permanent corporate bid underneath the asset class, completely independent of retail sentiment on social media. If you are managing an active digital asset or stock portfolio today, the data demands an immediate shift in your macro thesis. You cannot navigate this institutional landscape using retail tactics from 2 years ago. Stop basing your market thesis on temporary 20% drawdowns. Look at the underlying wallet addresses and institutional product filings. The real accumulation is happening on the plumbing layer. The real accumulation is happening on the plumbing layer, not the speculative surface. Prioritize networks like Solana and Ethereum that are actively absorbing tokenized corporate assets. Recognize that you are fighting an uphill battle against Wall Street's liquidity if you don't. The mandate from firms like BlackRock and Ondo Finance is loud and clear. Capital is demanding organic, systemic, on-chain yield. Pivot your long-term strategies toward composable, asset-backed instruments that generate real value through market cycles. Let's bring it all home to the definitive reality of today's market. The noise. Crypto is stuck in endless distribution, the ETF hype is dead, and the retail market is running out of gas. The signal: the SEC is rewrite the rules for on-chain assets. Exodus and Ondo have dropped 200 stocks on Solana, and BlackRock is launching a yield engine. The institutions aren't killing public crypto networks. They are turning them into the primary capital pipelines for the next century of global finance. The architectural migration of the world's wealth is accelerating by the hour. Stop staring at micro price drops. Start positioning where the real infrastructure is being cemented. Stay sharp. Stay focused. That's it for this edition of the Signal and Noise podcast. My name is Newell. Do like and subscribe. Track the plumbing. Ignore the social panic. And we'll see you on the next block. Please, this is not financial advice. Do your own research.